Dear all, welcome to the International Fiscal Association, in short IFA, Asian Pacific Tax Webinars Program, hosted this time by the IFA Hong Kong branch. For the remainder of this year, please expect similar programs to be organized by India, Japan, and Korea, respectively. As you might know, the IFA Asia Pacific is represented by different IFA branches from the Asia Pacific region. Consequently, the panel members and participants of this tax webinars program are also from those various regions. You will be pleased to know that the following Asia Pacific countries, next to Europe and North America, join us today. These are Thailand, South Korea, Australia, India, Japan, mainland China, Taiwan, Indonesia, Malaysia, New Zealand, Singapore, Sri Lanka, Dubai, Kuwait, Russia, and last but not least, Hong Kong. We welcome you all. My name is Willem Jan Hoekland, and I am a member of the IFA branch Hong Kong Executive Committee. As we have quite some participants today, it should be around 280. The following house Zoom rules have been implemented by us. The participants' mics have been muted and they cannot unmute themselves. If you have any questions, please send them to us, preferably to the moderator, through the chat box. And as far as you have not done so, please also have your camera switched off. It will be only the panel members that will have their cameras and mics on. So I now hand over the floor to Michael Olesnicky, who is also an IFA branch Hong Kong Executive Committee member and the moderator of the first session of today. Over to you, Michael.
Thank you very much, Willem Jan. Ladies and gentlemen, good morning, good afternoon, or good evening, wherever you are in the world. And the topic of this first session of this series is non-tax competition. What is it and what are the benefits we can expect from it, if any? And just by way of introduction, we've all of us gone through the experience of BEPS version 1 with its 15 action plans. We're now dealing with BEPS version 2, dealing with the tax impact of digitalization, and more relevantly for our purposes, Pillar 2, the issue of global minimum tax rates. Now, the stated reason for these initiatives dealing with tax rates, and this is according to the OECD and also the EU, which is operating in tandem with the OECD, is to counter the negative effects of what's called tax competition. And tax competition is described as the race to the bottom, as some jurisdictions lower their tax rates or impose no tax at all in order to encourage multinational enterprises to invest in their jurisdictions, or at least to set up companies in their jurisdictions. Now, these jurisdictions might have few other advantages when it comes to attracting foreign investment, and so they seek to make themselves attractive to multinationals by competing with low tax rates or even zero tax rates. Now, this strategy impacts negatively on the tax revenue base of the more developed jurisdictions. So not surprisingly, the more developed jurisdictions, led by the OECD, wish to take countermeasures to ensure the integrity of their own tax bases and to ensure that multinationals pay their fair share of tax, however you define that to be. But this is the issue, and this is what this webinar is about. If we push aside tax competition, what other types of competition for the business of multinational enterprises will emerge? Because we can't simply expect jurisdictions affected by the Pillar 2 initiative to simply do nothing. They will seek to preserve their attractiveness. And the question we're going to address today is, how do we make, or how do these jurisdictions make themselves more attractive? So to lead us through this discussion, we have 4 additional speakers. I'm simply a moderator, and I'm going to leave it to the four panelists to deal with this issue. First, we have Sarah Chin from Deloitte, and Sarah previously led Deloitte's China and Asia Pacific customs and VAT practices before her current role, which is she's now Deloitte's Global Chief Operating Officer for tax and legal. We have Jesse Kavanagh. Jesse is an international tax partner. He's the leader of PricewaterhouseCoopers Hong Kong tax reporting and strategy practice. He's worked in Hong Kong, he's worked in Australia and the United States. He's held in-house positions and leadership roles in addition to his current professional role. We have Leonard Khaw. Leonard is an international and an M&A tax partner with Deloitte, more than 40 years in the profession. Goodness, Leonard. Working in the UK, in Australia, Indonesia, China, and Hong Kong. He advises global multinational groups in relation to their operations and investments in the Asia Pacific region. And finally, by no means least, we're doing this alphabetically, we have Noam Noked. Noam is an assistant professor of tax law at the Chinese University of Hong Kong. His focus is tax, and he's also a tax consultant with Baker and McKenzie in Hong Kong. Okay, so the way we've divided this is to pose a number of questions that I'm going to throw at the panel, and that will just stimulate a discussion. If you do have questions, by all means, please use the chat function in order to communicate. So here's question one. Before we talk about the alternatives to tax competition, let's just examine where we are today with this whole issue of tax competition. We know about Pillar 2, and we're not going to go through that in any detail. But the most interesting development in the last few weeks has been the Biden tax proposals, where the US seemingly may have signed on to the OECD initiative. So the question is, and Leonard, I'm going to start with you. I'll throw you this question. What impact do you think the Biden tax initiatives are going to have on Pillar 2 and the whole issue of global minimum tax?
Well, according to Biden, his proposals are going to be a generational achievement. Are going to, they're going to have what they call a generational achievement. One part is clearly end the race to the bottom, as you say, Michael. But also they talk about establishing a equitable tax architecture. Okay. Now, in terms of the proposal, let me just remind the audience concerning the proposal. Two parts. One part is US minimum tax on US headquartered multinationals. They're going to increase the rate to 21%. Okay. Instead of global base, they're going to adopt country by country, similar to, IIR. And they're going to remove the 10% carve-out that's in the rules at the moment that's tied to qualified business asset investment. Okay, so part one, reform the US minimum tax up 21%. Many of you would have heard of the US BEAT tax, the base erosion anti-abuse tax. That's going to be repealed, and they're going to replace it with what they called a SHIELD regime. I always have to refer to what SHIELD stands for: stopping harmful inversions and ending low tax developments regime. SHIELD, okay? Now, what that really is that it's a regime, anti-avoidance regime, that's consistent with the general Pillar 2 concept of UTPR, untaxed payments, or under-tax payments rules, okay? So, if you stand back and look at it, the proposals are supportive And you might want to say, in alignment with Pillar 2. So I think, Michael, my bet is Pillar 2 is going to go ahead. Of course, the question which we'll pose later on is what do we make of the 21% minimum tax on foreign income in the US, right?
Well, actually, let's throw that question now, Leonard. I mean, when Biden suggested this 21% tax rate, do you think he was suggesting that only for US domestic tax purposes, or was he suggesting that this should be the Pillar 2 minimum rate?
I've taken a straw poll of my colleagues who know much better than I. I think the jury is out. I really don't think that, at least none of my colleagues think that the US is suggesting a 21% minimum tax rate for Pillar 2. In fact, I don't think 21% would fly, right? Given what we know of the of the other stakeholders in Pillar 2. But I dare say, and I'll put myself out on a limb here, Michael, I think 12% to me seems very low.
Yeah, well, 12% is the OECD rate. So we'll see what's going to happen. And certainly, if the US is looking at 21%, you would think that might get the OECD countries thinking that maybe they can be more adventurous than just a 11 or 12% rate. Jesse, I know you've done some benchmarking about Pillar 2 and what its impact is going to be on. Jesse, I am going to start with you again, but let me introduce the question. The real issue is, how are jurisdictions going to respond to Pillar 2 and the global minimum tax, whatever the rate is? And I've just posed the question here in the context of Hong Kong and Singapore, but this issue applies with respect to any jurisdiction with a low tax rate. Hong Kong and Singapore are particularly interesting because they do have legitimate tax systems, but they also do have a relatively low effective tax rate. And so here in Hong Kong, we scratch our heads and we wonder, what are we going to do when Pillar 2, if Pillar 2 comes into effect? Jesse, why don't you lead us with a bit of background to this, and then I'm going to ask Noam to comment as well, because I know he's written quite a bit about this. So Jesse, why don't you kick off the discussion?
Super, thanks Michael. And I think we need to start here by breaking the potential response into two baskets. So the first is, does the jurisdiction concerned adopt the international tax rules, the income inclusion rule, under tax payments rule, subject to tax rule, etc.? And in the basket, does the jurisdiction impose some form of domestic minimum tax? Let me start on the international rules first. And I really think Hong Kong and Singapore are going to be under strong pressure, and other jurisdictions like Hong Kong and Singapore are going to be under strong pressure to adopt such rules. And I think there are two reasons for that. First, there's the political pressure of being part of the international community and not having the potential threat of being blacklisted, etc. But secondly, and perhaps more importantly, there's the revenue aspect. If Hong Kong and Singapore don't adopt the international rules, then they're effectively giving up tax revenue to other jurisdictions. So let's take an example of a Singapore headquartered multinational. If Singapore doesn't adopt the income inclusion rule, then the next entity or the next jurisdiction down the chain is going to have the obligation to do so and will collect the tax, i.e. Singapore misses out. And similar situations arise if the jurisdictions don't adopt the under tax payments rule and the subject to tax rule. So I think there's going to be real incentive for a majority of jurisdictions to follow. If we turn to the domestic rules, I'll pass over to Noam, please.
Yes, so on the domestic side, it's important to remember that GLOBE Pillar 2 doesn't address issues of domestic taxation of domestic entities. Both headquartered multinationals, let's say if it's a Hong Kong headquartered multinational, the entities in Hong Kong, given they pay tax below the, let's say 12.5%, they will not be subject to tax in Hong Kong with respect to that income. And the same goes for foreign multinationals with domestic constituent entities in Hong Kong. So the concept of GLOBE Pillar 2 is how to impose tax on low tax constituent entities in other jurisdictions, not in the domestic jurisdiction. So Hong Kong and Singapore will almost certainly follow the new international tax standard if there is a consensus, following the reasons that Jesse mentioned, not to be blacklisted, to be good citizen and following the rules, and also to gain the revenue that otherwise will go to other jurisdictions. But for domestic local entities that will be taxed by other jurisdictions' globe rules, there are different approaches that we are now waiting to see what Singapore, Hong Kong, and other jurisdictions would adopt. One approach would be to do nothing, which is, let's say Hong Kong doesn't tax this income. Hong Kong has primary taxing rights with respect to this income. It's the source jurisdiction, but it doesn't tax it at the minimum level, and other countries will tax it under their IIR rules or UTPR rules. And this means that the incentive for these corporations to invest in Hong Kong will decrease, and at the same time, Hong Kong will not collect the tax. So it will suffer the harmful consequences of taxation without getting the tax revenue. Second option is to increase the ETR, the effective tax rate, through various tax measures, such as increasing corporate income tax or repeal tax incentive scheme, change source rules, impose taxation on capital gains, and various other measures that would likely affect both multinationals that are in scope and also out of scope other taxpayers that will not be subject to the globe regimes in other countries. And this might not be desirable in Hong Kong or politically feasible because of domestic taxpayers might object to these measures. And the third option is to adopt a domestic minimum tax modeled after globe. So it's possible for a jurisdiction like Hong Kong or Singapore that adopts globe to extend the same top-up mechanism also to domestic entities. So this will not be as part of the globe package. That's not what the OECD is developing and proposing, but it's a tweak that is very simple to do, both in terms of the legislation and also in terms of the compliance, because multinationals will already know how much top-up tax should be should go for the Hong Kong entities to the constituent entities in Hong Kong or in Singapore. So instead of paying this tax in other jurisdictions, they will pay this tax domestically. So for the rationale that Jesse mentioned of not giving up on tax revenue that could be collected in Hong Kong and Singapore, other low tax jurisdictions, they can adopt that. We are waiting to see what guidance the OECD provides, if they choose to provide further guidance to confirm that these type of taxes would be covered taxes for the purposes of globe. The blueprint appears to be supportive of this approach, but it appears that that's one approach that jurisdictions can consider.
So you raise a good point, though. If Hong Kong, just by way of example, any country doesn't impose its own IIR in order to collect this tax, they're simply allowing another country to tax their resident entities instead. So that seems to be a pretty strong incentive to have an IIR, which is effectively like a controlled foreign corporation rule, but of a much more expanded variety. So that's kind of interesting. But then let's go back to your notion of a domestic minimum tax. If we impose an IIR, if we impose a domestic minimum tax, do we apply it only to those entities that are within the scope of Pillar 2? In other words, that exceed the 750 million euro threshold of revenue every year? Or do we apply it to all taxpayers, whether they're above or below that threshold? How far should we go in actually imposing this tax? And can we get away with just imposing a minimum tax only on larger multinationals? Who wants to handle that question?
I'll proffer my view, and then others can add theirs. Well, I think the starting point is whether the jurisdiction, for example, Hong Kong, right, whether the jurisdiction sees there is an economic imperative to increase the local tax rate. So if you see that there is an economic benefit or imperative to increase the tax rate, by all means, increase it for everyone, okay? However, if what you say is that the current tax system that produces the current tax rate is fine, and I'm only responding to international pressure, then my view would be, why not just limit it to the taxpayers, that are affected? Basically respond to the problem. Don't try and create another problem. That would be my view. And there are many examples where there are tax rules that apply to certain groups of taxpayers and not other groups. So I don't see a problem with having a bifurcated tax system.
Yeah, although that does add to complexity, but I see your point. Noam, do you think the OECD will accept that type of minimum tax that's aimed only at large corporations?
The OECD hasn't provided guidance on this point. It appears, based on a few comments in the blueprint for Pillar 2, that it's possible to impose or to adopt a domestic minimum tax modeled after GLOBE, but the OECD hasn't provided much guidance other than 4 references. 2 of them are in footnotes. So that's why it would be helpful to see or to get it confirmed with the OECD that this approach would be permissible. Okay.
And, at the end of the day, this is all conjecture at this stage, isn't it? We're really waiting to see the final proposal due out in July of this year. We assume it will come out. We assume that it will be a final proposal, not really something with lots of questions or identifying issues that still need to be resolved, as the last blueprint was. So if we were having this conversation in August, I suspect it would be much more definitive than where we are now. But it does raise an issue for all of our jurisdictions. How do we respond to this? And I kind of sense that some jurisdictions have thought about this more than others. All right. Yes, please.
Just one quick thing to add. We've talked a bit more conceptually about how jurisdictions might respond. We also do have some public statements from Hong Kong and Singapore as to how they may respond. And so just to remind our audience, for Hong Kong, public statement that Hong Kong intends to actively implement the international rules according to international consensus. And there was also a commentary in there that it's likely that they would try to minimise the impact to small and medium enterprises that aren't within that threshold. Whereas for Singapore, the latest statement in the budget was, if and when these international tax rules are changed, we will consider if adjustments are required to our corporate tax system accordingly in consultation with the industry. So that's the latest that we've got from the 2 jurisdictions.
Okay. Well, we are going to see, I suspect we are going to see changes to our tax systems, all of us, and it does make tax kind of harder, doesn't it? Any other questions for your comments before we move on? Okay, let's go to the next slide. Sarah, let me throw this question at you. Pillar 2, I mean, this whole initiative is designed to kill off tax competition, to get rid of the evil of double non-taxation. And so if we look at that objective, what do we think? Why don't you start on this, Sarah? Will Pillar 2 kill tax competition?
So, Michael, I think in typical accounting or advisory talk, I'm going to answer this question as it depends. And it's going to depend purely on 2 points. So these are 2 points I'd just like to elaborate a little bit here. If you look at the blueprint, I think there are 2 matters that need a lot more work. The first one has already been discussed quite a bit in the opening sections. So the first one's really that the blueprint leaves some kind of additional work and political alignment, I would say. So the panel's already talked about what could be the minimum tax rate, and that is actually quite a critical question for us to understand because it affects the whole computation, and it's quite an important variable in the whole computation. So Leonard started off with 10. I think he Leonard started off at 12, I'm sorry. And various members of the panel have talked about 11. So I think where we're going for is potentially, is it going to be 10 or 12? So that will be the range that we're looking for. And it's actually still quite a low rate. So whether they land on 10 or 11, I think it's still very, very competitive. But whilst we're waiting for the new rules to come in, I think a lot of decisions will be influenced by the politicians as such, and not necessarily only by what we call the technocrats. So the second point I'd like to make is really regarding the materiality threshold that's been mentioned. So it's not very clear yet, and this is subject to the tax law which would apply to the MNCs. Is the threshold that's been mentioned of 750 million euros of global revenue. I think Leonard probably would be joking that many companies will be focused now on this 750 million euros and probably doing all that's possible to see how they can be under that threshold. So the word that's been used is really what containment measures will there be for companies that are not within this threshold. So I think the blueprint is suggesting that really for the micro or the small and medium enterprises, they should be out of scope. And they seem slightly not inclined to scope out larger groups, but I think this will be the one to watch. So really the combination of the tax rate and the threshold will probably hope to give you the answers to your questions, Michael.
Okay, and look, you raise a good point. 12%, it's, it's respectable, but it's still a lot lower than the average OECD corporate tax rate, which is around 24%, I think. Jesse, any thoughts? I mean, if the global tax rate minimum was set at 12%, is that the end of tax avoidance and tax competition?
I think I've got to agree with Sarah. I don't think that's the end of it. But I think it does have a diminishing impact. As we saw from the modelling, a number of our multinationals that we put the data together for were going to have an impact even at that 12.5% rate. So if anything, I think it may lead to further work and further modelling from them to determine how to address the rules. And
Leonard, if Biden were to convince the OECD to make the minimum rate 21%, what do you think then?
Well, it's quite interesting, because, just look a little bit at Pillar 1 for a start. The US proposal on Pillar 1 is to shrink the number of multinational enterprises to top 100. Okay, so that's quite interesting. And then, of course, the first question is, where will they end up in terms of, who's involved? And the second one is, will Pillar 2 be totally dependent on Pillar 1? Or will countries, introduce elements of Pillar 2, which, to entities that are not affected by Pillar 1? So, I think right now, Michael, I think we should wait for July and then have another look. But I'm sure there'll be a lot of thinking amongst the countries in terms of who blinks first.
Okay. All right, so it appears it will have an impact on tax competition. It may not kill it completely. And this kind of now gets us to what I think is really the main thrust of this webinar. Okay, let's assume that overnight tax competition vanishes and countries can no longer compete on the basis of their tax rates. So what, and here's the question we pose, what new types of competition between nations for foreign investment will emerge? How else will jurisdictions compete for multinational business? Now, maybe I'm going to start here with Noam, because Noam, I know that you've written quite a bit about this, particularly on the issue of subsidies as one possible form of competition. So can we let you start with that, and then we'll take that discussion further?
Yes, so what we have been saying since the BEPS project, so now in BEPS 2.0 is a continuation of this trend of pressure on multinationals and on countries to engage in less tax incentives and tax competition and to substitute it with subsidy competition. So in this slide, we have an example of a multinational that needs to decide whether to invest in country X or country Y. And we assume that the expected income before tax is $1,000, or you can multiply it with as many zeros you would like. Country X would offer a tax incentive, which is, it's going to be $1,000 tax-free income generated in that jurisdiction. Country Y can design it in a way that achieves a similar result by taxing the income at a 20% rate and providing a non-tax subsidy at the same amount of, let's say, 200. And let's assume that the non-tax subsidy is not subject to tax in itself. So both countries would provide a similar benefit to the multinational, but one will do it through the tax system, whereas the other one will tax and then through the fiscal system return an equivalent amount. And any reference that I make here, it's a cash subsidy, but it can be structured in various other ways. And the references to tax are references to corporate income tax. It can be a refund or a subsidy in the form of other types of taxes, or it can be in goods or services provided for below market value, or cash or other in-kind benefits that could be provided to the multinational. So Michael, can you move to the next slide? In this slide, I would like to make the argument which multinationals are better off when they receive subsidies instead of equivalent tax benefits since the BEPS project. And this trend will be accelerated and strengthened following the Pillar 2, if there is a consensus and adoption of Pillar 2. The first point is that multinationals are at risk that other jurisdictions may try to tax untaxed income. And it's better to pay tax on the income and receive a non-tax subsidy equal to or greater of the tax that was paid. And we can identify a few BEPS action items that create preference for non-tax subsidies. One of them is the CbC-R. If you look at CbC-R, some of the hotline items are the how much tax you paid, what's your effective tax rate that you can calculate based on a tax paid on cash basis. If you don't pay tax as a result of a tax benefit, then your tax payment will be zero, your effective tax rate will be zero, and other jurisdictions might attract attention of those, trigger audits, and potentially misuse of the CbC-R information, that even if you can convince a jurisdiction, a tax authority, that what you have been doing is following a non-harmful tax incentive scheme, and that's the reason why you pay so low tax in a jurisdiction, they might still suspect that what you have been doing is profit shifting that is not legitimate. So CbC-R creates a risk already. Second element, Action 5, spontaneous exchange of tax rulings. So tax rulings have to be exchanged with the relevant jurisdictions that are affected by that, and subsidy rulings are not required to be exchanged. So currently, we have high level of transparency with respect to any sweetheart deal given with respect to tax, but we don't have a similar level of transparency with respect to subsidies. And the third item, Action 3, it's not a mandatory item, but we have seen that the EU and various other jurisdictions have followed Action 3 and imposed CFC rules. When we have a CFC regime, and Pillar 2, the IIR rule, is basically a CFC regime, when the underlying entity, the subsidiary that is subject to the CFC rules, pays tax, it is less likely to be subject to taxation under CFC rules. And even if it triggers some level of tax, there will be tax credit available to be creditable against the CFC tax liability. So that's the incentive for multinationals to receive subsidies that are non-corporate income tax subsidies instead of tax benefits. Pillar 2 will do the same as CFC rules. So it's much better for a multinational doing business in any low tax jurisdiction to pay a tax, at least at the global minimum level, and get, let's say, land right use or other forms of subsidies, or even employment tax reductions or other concessionary taxation treatment on non-corporate income tax. For countries, that's the second point, they are better off if they provide non-tax subsidies instead of tax benefits. And first reason is that multinationals prefer them. And Jesse can elaborate next that multinationals have already preferred non-tax subsidies. It's always better to have cash in the hand than a potential tax benefit in the future. But now, as a result of BEPS and of Pillar 2, there is even a stronger preference for that. So countries can attract more M&E investment, more foreign direct investment at the same cost. And the second point goes to the transparency and also the scrutiny by the OECD and the EU that have had scrutiny over preferential tax regimes. For example, Korea was blacklisted in the harmful tax competition EU exercise for preferential tax regimes for foreigners. And there is no similar treatment of subsidies, so much less scrutiny. There is still WTO and EU state aid rules that might apply, but they apply equally to tax benefits and non-tax subsidies. So I'll turn it back to Michael.
Yeah, and Noam, you put Jesse on the spot, so let me now turn over to Jesse. Jesse, you used to be in-house for a very large corporation. I won't name them because I don't want people to think you're speaking on its behalf. But generally, how do you think multinational corporations would view this choice between a tax incentive on the one hand or a subsidy on the other hand? Is there a preference, or do they work together side by side?
Yeah, thanks, Michael. And the comments I'm about to make aren't just specifically from that experience in-house with one organisation, but from what I've seen in a couple of in-house roles and then working with clients. And it really, it echoes and complements what Noam was saying. I think he's outlined really well a lot of the tax technical reasons why subsidies are often preferred versus a tax incentive. But let me talk about three potential practical reasons that an in-house organisation might think of that are above and beyond those tax technical ones. And the first is that some organisations, when they're doing the modelling for the financial impact of different alternatives, taxes might be below the line. And we might see that they are rewarded or assessed based on a financial return in the future that's on a pre-tax basis, in which case tax incentives won't impact the business unit and won't be as important. Secondly, even if that's not the case, tax incentives, as Noam mentioned, are generally dependent on having tax liabilities to offset. So if you've got a new business operation that's going to generate losses in the initial years, you might not ascribe much value to a tax holiday for 5 years, for example. And then third, and this is probably in extreme cases, but in some extreme cases, multinationals with large negotiated tax incentives might apply a discount for political stability when they're doing their modelling. And this reflects the political risk of a future change in government, and that future government might potentially want to distance itself from perceived favourable treatment that the predecessor government gave to foreign investors, and therefore backtrack away from non-legislated tax incentives. So I think there are a number of practical reasons over and above the technical.
Yeah. So now I'm coming back to you. You talk about subsidies, and subsidies for what? This could be for R&D, I suppose, other types of activities.
Yes, so R&D subsidies are quite easy to design in a way that is similar to R&D tax incentives, assuming that there is some taxable income, because they could be based on the same factors, which is R&D expenditure. So if we calculate the R&D a super deduction or enhanced deduction or some R&D tax credits, they're available, as Jesse mentioned, only if there is some taxable income that these credits will be set off against. But assuming that there is, we can just impose the tax and give cash subsidy based on the same expenditure. So we can substitute them fairly easily for R&D tax incentives.
Okay.
But more generally, we can look at multinationals and governments as repeat players. They are competing, but some of them have long-term relations and relationships, and there might be political instability in some locations. Governments have been negotiating actively with multinationals, and there is political uncertainty. It might be that it's harder for governments now politically to grant cash subsidies over tax benefits. That's why so many governments have preferred to offer tax benefits. But now, as a result of BEPS and Pillar 2, governments will likely be under more pressure to adopt other forms of non-tax competition.
Leonard, what other types of subsidies could you envisage or do you see around Asia Pacific?
Well, I think a very easy way to do, take a P&L of a company, go to the trial balance, look down the expense lines. And I think, Michael, I think you'll find that the tax line is big, okay? It's normally a big expense of a profitable business, no doubt, okay? But it's not the biggest, okay? You start from the top, right? Think of VAT on your sales, right? And China is well known. If you local authorities in China, they look at the VAT that they collect from your business, and subject to various negotiated conditions, they give you a refund of a portion of the VAT. So think about 10% of your revenue, even a small percentage of 10% of your revenue is quite a big number, yeah? That's one. Then you go down to your employment costs, right? Your employment costs. You deduct taxes, payroll taxes from your employees, right? Governments are known to give you subsidies, reference to that. They say, you collected 100 million for me, I'm going to give you 10 million or something like that, right? And you see that in China. Social Security, well, that was one of the big things in the last year over the COVID-19 crisis. You see governments basically saying, don't pay me the Social Security until times are better, right? That's actually a very big benefit in the P&L. And then you go to, other lines like rental, office space, factories, and governments are known to be saying, come to my country. I will ensure that you have a really, really, really spanking new factory. And by the way, here, nominal rental. That's a very, very big incentive, right? And then you can keep going down to, R&D. I help you find people. I keep my, labor rates low so that you come to my country. So the list goes on and on and on, right? It's actually quite, I see this is going to be a very big area of competition, Michael.
So when I listen to you, I say, well, who cares about tax concessions if you can get benefits through other means?
Well, if I give you 10% off, if I refund you 10% of your VAT, is a huge number.
It is. Yes. Can I turn to Sarah? Because Sarah, your background has been trade. And fascinating when we were discussing this, because you started talking about trade competition and how countries can make themselves attractive by offering other benefits via the trade route. Do you want to expand on that?
Yeah, what Leonard mentioned is quite interesting, because if you kind of look at benefits and so forth, trade I think tends to not be the one that people focus on. And if you're speaking with a lot of in-house people, you'll find that it's not a focus because it's just part of whatever costs you have in the production and the manufacturing the goods. But I think it's an important component because it's a customs duty that you are looking at. And unlike most of what we have been discussing today, it's not a tax per se. So it's not something you can claim back. It's not something you can play around with. The problem is it's a levy, so it's due. And that levy is normally buried into the source and it's managed by the supply chain people. So tax function wouldn't necessarily see it. But I think it is an important component because it will influence the decision of any company where they source and where they manufacture from. So the fact that it is forgotten, I think sometimes, when customs duty, there's an audit, gets into trouble, or the goods have been stuck at the border, then it comes to tax's domain to solve. So I think it's largely an afterthought. But what I do want to say is that there are lots of things you can do with tax, with trade, with the customs duty, and largely to do with what domestically they would offer by way of special trade facilities that will help you get your goods out, it will help your foreign exchange. And China has set up a lot in the past 10 years. Special trade zones in Shanghai, for lots of different reasons. Trade is one of them, lots of special bond zones that are what I call heavens in the sky, because they are basically duty-free territories. So if you look at trade, the other thing I want to really focus on are what we can legally do through the use of what we called trade agreements, most notably the free trade agreements. And there's been a lot of attention on this recently, largely brought about because of the trade spats between US and China. So a lot of people have turned to the FTAs and say, what am I not doing and how much money can I release? Are there better countries for me to work with so I can source? So for example, if I just focus on Thailand, Thailand has a lot of silver, which is being mined, and a lot of people focus on using that silver for whatever manufacturing of the jewelry. And there's a beautiful free trade agreement between Thailand and China, where you don't pay any duty on the silver that you source from Thailand and you bring into China. So that's an example. And I think because of the trade spats that we've seen in the US, a lot of people are going out. The US multinationals and the Chinese multinationals and the Japanese as well, a lot of them are looking into other countries, especially in Asia Pacific, where they can develop and manufacture more. So they're offering better trade reliefs. So Vietnam and Cambodia has come up into play. Much lower costs in terms of taxes. They sometimes can have an attractive guide to do business in those countries. But I think the challenge with these emerging markets is really whether they will ever be able to build scale and have the infrastructure to facilitate the manufacturing function. But I'm just finishing off on the free trade agreements. There are two that I want to just remind everybody, both slightly political, but both quite interesting, and both are multilateral. So the first one we are very excited about is the Comprehensive and Progressive Agreement for the Trans-Pacific Partnership. So it's a bit of a mouthful. There are two short terms that we use, CPTPP or TPP-11. The TPP-11 is because there are 11 countries involved, and there are a collection of these 11 countries which are actually based out of Asia Pacific. So for those who are interested, it's Australia, Japan, Malaysia, New Zealand, Singapore, and Vietnam. So the CPTPP was actually the formation after President Trump decided to pull the US out of the TPP, the Trans-Pacific Partnership. So the 11 countries decided to go on their own, and they built quite a nice kind of trade agreement, which is going to lots of different sectors. So it's not just looking at trade, they're also looking at subsidies or incentives for financial investment and also intellectual property. So this one is quite an exciting one, especially the focus on this region. And a lot of, I think, discussions today, and we started off talking about the US and politics. When Biden came into his presidency, we were watching very, very carefully whether he would allow the US to rejoin the TPP. And I think he has talked about a potential interest to rejoin the program, but we don't see that Biden is particularly in a rush to bring the US back into TPP. And I think a lot of the issues is to really focus on domestic issues that he needs to solve and trying to get the country up and running again post-COVID-19. So please do look at the free trade agreements is what I'm trying to say, because there are lots of beautiful benefits, and I think it often gets overlooked because people may find it somehow a little bit difficult to implement. But I actually have one client who managed to save 90% of their duty costs by doing nothing but looking at the free trade agreements. So Michael, I'll stop there and pass back to you.
Okay, thank you. I know I'm only a moderator, but I can't resist just making my 2 bobs worth here for just a moment. You'll see on the slide there, I've got in the middle bullet point, the labour rates. And I raise that because when the Pillar 2 blueprint came out, one of the comments came from the OECD's own, sorry, I forget the name, it was the labour body within the OECD, the labour group. And they raised this concern. They said, look, if we eliminate tax competition, then multinationals will start deciding jurisdictions based on other factors. And for example, they might start deciding to set up operations in jurisdictions where there are low labour rates. And this is bad because we don't want to encourage the use of cheap labour. And so it raises the issue that at the end of the day, there is going to be other types of competition. And at what stage do we say it is legitimate for a global body like the OECD to step in and say, we don't like this type of competition? Tax competition, we've always accepted it, but now in the last half dozen years, we've decided we want to kill off tax competition. If we compete on labour rates, will we say this is bad? We don't want to encourage the use of cheap labour. It creates an unfair competitive environment. We will slap down on that. We will provide disincentives for multinationals to go to places where there are cheap labour rates. And where do we stop? With infrastructure, will somebody say, China has a much more modern infrastructure in its main cities than the US or than BVI, for example? It is unfair for China to seek to attract business on the basis of its modern infrastructure. I mean, where does it, what if we say one country is a nice place to live and therefore that's where we want to go and work? Is that an unfair competitive advantage? And this whole issue of tax competition, we're only kicking the ball down the road. We're just replacing it with other types of competition. And inevitably, I just wonder whether the countries that get disadvantaged by this will turn around and say, this is unfair competition, and do a BEPS type of attack on those types of competitive advantages. Anyhow, that's just me getting that off my chest. But let me ask the question. If you were designing, if you were in a jurisdiction like Hong Kong, like Singapore, like India, like Malaysia, and you had to design a system to make your jurisdiction acceptable to foreign investors, what should we be aiming for? If we take tax out of the equation, what do investors look for? Sarah, you want to start on this?
Yeah, I'll be very quick so I can give time to the other panelists to speak as well. But I think Jesse and I were discussing this a few days ago. It's really the ease of doing business in a particular country. And a lot of that will be regarding foreign exchange regulations, reporting requirements, how aggressive are the tax bureaus in terms of doing audits, and the details that they would want in order for them to perform the audits. I think it does influence, especially the appetite and the patience of many of the multinationals doing business in that country. It's really the ease of doing business, and I think language is also quite an important point because it affects the culture. Jesse, I don't know if you have anything you wanted to tag on to this.
Yeah, thanks, Sarah. Yeah, just on one client that we did have that actually looked to migrate their regional operations from one jurisdiction to another because unfortunately they went through a tax dispute in their original regional headquarters location, and the tax assessor came to the conversation at one point and said, we're not here to have a technical discussion. We're here to work out how much extra revenue we can raise. And this particular client said, if that's the approach, this is a big issue for us, we're moving elsewhere. So that's just one small example.
Leonard, you've read the Investec HK report. I think many of us have. What did you glean from that? Well, what is the Invest HK report?
Well, it's actually quite interesting. They surveyed 9,000 companies. So these are all subsidiaries of companies headquartered outside. So parents outside Hong Kong, companies in Hong Kong. 3 groups: regional headquarters, means companies have managerial control over subsidiaries in other countries or sister companies in other countries. Regional offices, coordination only. And then lastly, local companies. So responsibility for just Hong Kong alone. And the 9,000 divides about more than 50% are local. Then 2.5 thousand over 2.5%, also 25% regional offices, and 15% regional headquarters. Okay. Now, in terms of the industries, what they do in Hong Kong, import, export, retail, wholesale, finance, professional services and other services, interestingly, is really around those types of activities in Hong Kong. And in terms of jurisdictions, US, mainland China, Japan. The top ones depends on the groupings. For example, regional headquarters, US is at the top, but you know, in all of them, US, mainland China, Japan. Top 3, in the interest of time, Michael, I'll just go to the top 3, what they actually say they are worried about, and I will tell you in 1 second. Just bear with me. Number 1, most important, simple tax system and low tax rate. Admittedly, if I were asking the question, I would split the question into 2, but they didn't. So that's the first. Next one, free flow of information. And then the third one is corruption-free government. And Jesse, to your point, rule of law and independent judiciary. I presume they mean objective and bureaucracy that applies the law too. Anyway, those are the top 4. Interestingly enough, Michael, at the bottom of the list, 15 and 16, availability of and cost of residential accommodation, very low down. And availability of international schools. I have to tell all my colleagues that bleat and moan to me about international schools that that's the bottom of the list. But anyway, the top 4 is a simple tax system, low tax rate, free flow of information, corruption-free government, and rule of law.
Can I ask though, one question I don't think they asked in that survey, and we had a discussion about this, and I think it's worth concluding on that. What's the importance of lifestyle?
Well, actually,
to live.
Actually, let me see. I saw something.
Don't tell me I'm wrong, and it was surveyed, but
environmental quality is in there.
Not quite the same, but
not quite the same. No.
Leonard, I recall we had a discussion about a project that we'd worked together on in a past life. Did you want to touch on that? And
Oh yeah. Jesse and I worked together in the same firm in a past life. His past life, not mine. It was quite interesting. We had a multinational come to us and say, Hong Kong, Singapore, you know, how do we choose? Can you do a study? You know, go and do a study. Look at all the different factors of you know, setting up in Hong Kong, you know, operating in Hong Kong, as well as Singapore, and come back and tell us which one is better. So Jesse and us, plus others, we went and, we constructed a framework. And I think, Jesse, we did a lot of work, actually quite a lot of work, getting all the answers by rest of the framework. We summarized it properly. We went to the client and then we presented to their board, this is what the framework is, blah, 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 blah. And then we gave our opinion based on the framework relative to their facts and circumstances. And then, of course, they chose where they wanted to live. So there were stakeholders in the company that had a personal preference as to where to live. And after paying us a lot of good money for our work, and they thanked us and they thought we were, very good and all that, and they did pay our fee, they then chose where they wanted to live.
Yeah, and I think actually we've all had that experience, and it just goes to show, we can analyze these things to death, but at the end of the day, you're dealing with a lot of emotional issues here, and that factors into it as well. Ladies and gentlemen, we've reached the end of our time, so I just want to thank everybody, my panelists. Thank you, Sarah, Leonard, Noam, Jesse. We don't really have any questions, but I would refer you to Frank Mullins. I put this more as a comment than a question. And so therefore, based on that, I would just invite everybody to look at your comment, which I agree with. Are we handicapping jurisdictions by imposing these burdens? And it's a good comment. Thank you, Frank. Okay, so based on that, that's the end of our presentation. Being a webinar, I cannot ask you to applaud, unfortunately. But we're going to take a 15-minute break, and we will reconvene at 2:15. So please take a break, get a drink, go to the bathroom, and let's return at 2:15. Thank you, everybody.
Thanks.
Bye-bye.